Good morning. Welcome to IG's early morning call. It's Tuesday, 11th of July. Let's take a look at the headlines as we're monitoring some of the commentary around from the Federal Reserve to suggest that we could well be nearing the end of the rate cycle. As a result of that, we've seen the dollar weaken on the foreign exchange markets, and this has given a little bit of a kick to the Japanese yen, which we'll take a look at. Meanwhile, staying on the foreign exchange markets, is it time to continue, or should we be buying sterling across the board? We've seen some numbers out from UK retail suggesting consumers remain cautious, but could we be seeing a wage price spiral develop? We've just seen some breaking news coming through, which has seen wages rise at a record rate. Meanwhile, we are watching what's happening on Wall Street for the big banks. The risk assessment is to be reviewed to bring it in line potentially with Basel III. Take a look at volatility, down for a third day in a row, but I think this belies what's going on under the covers, because there is some big questions being asked now about interest rates. And in fact, this drop is partially due to what we've seen in the US markets, but it's done little or nothing for the European markets. There is a little bit of buying at the moment, 72.82 on the session, but you can see yesterday we saw the lowest intraday print that we've seen since the 20th of March, very close to breaking down to levels not seen since November last year. But as I said, a little bit of buying. How much is going to be sustained, I think, remains to be seen. But I think the shot has been fired across the bows this morning with this data showing that wage rises, excluding bonuses, are rising at a record rate here in the UK. And that is going to be a big worry for the Bank of England. Many suggesting there's still 100 basis points to go on the upside for interest rates, possibly more, taking it back up above 6% for the first time in many, many years. And that, I think, is going to be one of the big features of the London markets, particularly. Slightly stronger start to the trading day on the German markets. You can see a third day in a row of gains. We're now back up above the 100-period moving average, which not necessarily significant, but I think nonetheless it just underpins this move that we've got with money going into not just the German markets, but also France as well. Relatively strong candle on the upside. You can see nothing like the losses that we saw at the back end of last week going into Thursday's session. That was the 24-hour markets there. And indeed on Friday, taking us down there on the French markets down to levels not seen since the 27th of March. So it is just rebounding from recent lows. But nonetheless, money going in on a day trader's basis. You want to be long on these markets going to the start of today's session. Overnight in the Asia-Pacific markets, been relatively good trading day across the board. Nikkei 225, Hang Seng, S&P ASX 200, other Asia-Pacific Rim markets also enjoying a lift in the session in today's trade. All this coming off the back of a strong Wall Street close yesterday. We've got the early trade in the States reflecting the relative interest in the US markets. These are the 24-hour markets here. You can see the Dow, which yesterday bounced off this line of support at 33,604, and we've got a 24-hour markets building on that with now a clear candle above the close that we saw yesterday on the Dow Industrials. It wasn't such a strong day yesterday on the Nasdaq, but you can see we're not too far away from recent highs in any event. And as I was saying on Friday, this is just a small retracement, what is otherwise a continuation of the recent trend, suggesting we've got more upside to go. 15,086 on the Nasdaq. So I think things are looking pretty good. One of the reasons why we've seen this market rising is because the Fed, whilst it may well still have to raise interest rates by half a percentage point, which is what the markets are now pricing in. Yesterday, several Fed officials expressed their views. Let's take a look at some of those. For the San Francisco Fed President, Mary Daly, the Fed is nearing the last part of its hiking cycle. I don't think there's anything here necessarily that changes our opinions on where we are. It just underlines the fact that we are in that final hurdle. For the Fed Vice Chair for Supervision, Michael Barr, I'll just say for myself, I think we're close. Of course, not all Fed members are necessarily agreeing. Cleveland Fed President Loretta Mester told reporters yesterday, she said, if it was just me alone, I would have moved the rates up, but I understood the rationale for not moving in June. But the fact that disagreements are growing between board members also supports the idea that rates might be the bulk of the fact that the rate hiking cycle has now seen the bulk of the move behind it. And I think this is explained if you look at what's been happening with the dollar basket. We've got the fifth day in a row now of losses on the 24-hour markets, taking us down there now to levels not seen since the 11th of May. And you can see, I think, the direction of travel is on the way down. The next substantial line of support are these lows that we had here back on the 17th of April at 100.38. We're currently trading at 101.32. So this is beginning to build nicely for a short dollar position. Now, one of the functions of the weak dollar is that we've got money going back into the Japanese yen, which is going to help the Japanese authorities considerably because they were just recently saying that they were concerned about the weakness in the Japanese yen, giving pressures to the Japanese markets generally. And if we look at what's been happening across the board, I want to show you, first of all, the dollar trading against the Japanese yen. Now, for me, the fact we've got the yen down against a whole basket of currencies, and you'll know that if you've studied Dow theory, that the idea is that one of the tenets is that a number of similar markets are moving in the same direction. And I think this short Japanese yen trade is really looking quite sweet at the moment. If you haven't already got on board on this, put your stop fairly tight in over the candle today. So on this chart here, your stop would go just over the 142 level. 140.80 is where we are. Next line of support here, not too far away actually from where we are on the fib here at 140. That's the number to watch out for. Total retracement would take it down to 13,843. If you do go short on this, and it does continue on this trend, just keep on bringing your stop loss in. Let's take a look at the euro trading against the Japanese yen. Again, you want to be short yen against euros. Euros down against the Japanese yen. Sorry, short euros, I beg your pardon. Long yen, this trade is 155.11. You want to take this down here to the line of support on the 61.8% retracement at 150.69. And that would give you a continuation of that trend on the way down there as well. And it's against a whole basket of G7 currencies. This is the Aussie trading lower against the stronger Japanese yen at 94.13. Again, if you haven't ridden this yet so far, nice tight stop in with a view to taking this market on lower, giving you more money going into the Japanese yen. This is sterling at 181.67 on the way down against the yen and against the Canadian dollar as well. Just showing you what's happening here, the Canadian dollar lower against the yen as well. And I've put a fib on all these just to show you where the next line of general support is. But I mean, you can draw these lines any way you want. But the point is that we've got this market on the way down, which changes the direction of travel that we've seen recently for that weakness in the yen. So we're now talking about strength in the yen. You want to be shorting G7 currencies against the Japanese yen. Now, in Australia, consumer sentiment has improved in the month of July. The Westpac consumer sentiment rose 2.7% in July to 81.3, the biggest gain since April. It reflects an improvement on the consumer inflation front and the fact the RBA held rates at 4.1% at its last meeting. However, the index remains well below 100, and that's the point. It means that it either contracts or expands. Anything below means that pessimists still outnumber optimists. And this is for the 17th month running. Australian business conditions also improving. NAB business confidence rising to flat in June from a -4 in the month of May. Just looking at what's happening with the Aussie, it's not actually much moved. There is a little bit of interest in the Aussie against the US dollar today, but it's not much moved. Not as moved as some of the other currencies against that US dollar, which is almost across the board on the way down. Here in the UK, food inflation is weighing on shoppers' ability to spend on non-essential items, meaning a lot of the money that consumers have is going on essentials, not onto discretionaries. The British Retail Consortium Retail Sales Monitor was up by 4.2% year on year on a like-for-like basis. It is higher than the 3.7% increase recorded in May, but much lower than inflation. In other words, an increase in spending, but a drop in the volume of goods purchased. Now, the survey shows that so far, consumers are remaining resilient. Over the second quarter as a whole, food spending is up 9.8%, but the threat of further BOE rate hikes and the prospect of slower than expected economic recovery means consumers remain cautious. Non-food spending, according to the BRC, grew only 0.3% in the period. Now, on Thursday, a shock could come with the monthly GDP data that we're expecting. The British economy is expected to have contracted by 0.4% in May, month on month. Now, this would take the 3-month average to a negative 0.1%. We're nowhere near talking about recession yet, but it is a setup that economists are keeping in mind as many see rates rising a further 150 basis points this year. Now, about half an hour ago, we saw saw some shock data coming through here in the UK with wage data and unemployment numbers in the UK. Let's take a look at wages first of all, rising at a record pace. Now, this is fueling fears of a wage price spiral, which will inevitably lead the Bank of England to raise interest rates further. This is just a day after the Bank of England Governor Andrew Bailey said inflation will start to fall measurably. But average weekly wages, excluding bonuses, are up 7.3% as staff demanding more pay to keep pace with consumer price inflation, which has been running at or near double digits for much of the last year. Meanwhile, the unemployment rate rising unexpectedly to 4% in June from 3.8% in the prior month. Economists forecast unemployment rate remaining at 3.8%. Now, this has been one of the interesting trades that we've seen. And I think so long as we are expecting more interest rate rises here in the UK, there's an opportunity here to buy sterling. This is sterling against the US dollar, currently up at 129.01. 130 is this red dotted line up here, which now has to be the price target, which would then take us up to levels not seen since the 22nd of April, the top of that particular candle there. And that would be a significant move for sterling if you're long on this. Stop goes underneath recent price action, nice and tight, with a view to taking that further on up. Now, at 10 o'clock this morning, we get the ZEW, German ZEW economic sentiment number, expected to fall to a negative 10.5 in July from a negative 8.5 in June. The big thing about what's going on in the German economy is that we've already seen it go into recession in between the fourth quarter and the first quarter of this year, fourth quarter of last year. That was a winter recession. We had been expecting to come out of that, but it doesn't look like that's happening with any particular speed. If we look at what's happening with the euro dollar, you can see in today's session, for the first time since the 8th of May, we peaked above this line of resistance at 110.12, currently trading at 110.19, and that is breaking to new, what's at 6-week highs for the euro against the US dollar. Awaiting that ZEW data out at 10 o'clock this morning. Now, major US Wall Street banks are to have a major overhaul in the way they are assessed for their operational risks. If it goes through, it'll be one of the biggest regulatory overhauls since the financial crisis on Wall Street. Let's take a look at what we've got with recent commentary. The top US banking regulator, Michael Barr, says he wants the big banks in America to start using a standardized approach for estimating credit, operational and trading risks rather than relying on their own estimates, which has been the trend that we've seen since that crisis 10, 12, 13 years ago. He says the Fed's annual stress tests should be reassessed to better capture the dangers faced and to better align Wall Street with international standards known as Basel III. It may set up a clash over the amount of capital required to cover increased risks, as the banks have long fought against higher capital requirements. The announcement comes just days before the largest banks begin posting their second quarter results starting on Friday, with JP Chase, Citigroup and Wells Fargo. Just want to show you a couple of those charts. These stocks trade all sessions on the IG platform. And this news came out during yesterday's session. It didn't seem to spook JP Morgan too much. This is one of the world's biggest banks. That'll open all sessions on the IG platform at 1:45:36 at 9 o'clock this morning. JP Morgan, Citigroup and Wells Fargo are all sessions, and you can trade those when they report earnings before the bell on Friday. Now, let's take a look at just a couple of other areas of the market. One of the functions of that weaker US dollar, we've seen money going into gold, and it's up again today. If you can look at this chart here, you can see we had this bounce off this area of support at 1910, which we were talking about a lot as the markets were on the way down. This is the fib area of support, the fib drawn from the lows we had back on the 28th of February, and that record high move up that we saw to the 3rd of May. It's looking as though now we've got this market beginning to peak up at recent highs. The highest trade we've seen on this market now since the 21st of June, so 2 or 3 week highs for the price of gold as a result, as a direct function, I think, as that weaker US dollar going into the session in today's trade. One of the other interesting features of the markets has been what's happened with crude oil. Crude oil continues to hold on to recent gains, just bumping up underneath that 100-period moving average. That's US crude, Brent, exactly the same price action. I'm looking at that breakout to see whether or not there's any further upside to go. We'll have to see how things develop in the next few days. I don't have exposure to oil, but it's interesting to see this recent move up away from the recent tight boundary that we've seen put in place by this falling line of resistance. So we're now comfortably above that. Big question is whether or not we continue to rise. I guess it's all going to hinge on what the OPEC monthly report says on, I think it's Thursday this week, whether or not they're going to get a confirmation that the continued agreement between Saudi Arabia and Russia to tighten supplies. That's it. So got about 15 minutes to go before the start of today's European session. Nothing much necessarily to watch out for at the beginning of today's European trade, but I think we've got a little bit of money now going in to those markets. But I think we ought to continue to watch what's going on with sterling with that record rise in wage price growth, which could well stir the Bank of England into further rate rises in the months ahead.